right, so on the Money Show, we make sure that we just don't talk about investing in mutual funds, but also help you meet the brain behind these funds. In this week's Meet Your Fund Manager segment, we have on board Rahul Singh, CIO-Equities, Tata Mutual Fund. Let's listen in to this interaction where we talk about the current market movement and your investment strategy, and also what's going to happen in the second half of this year. Very crucial period in terms of interest rate and inflation and your portfolio return. Let's check this interaction out. All right, welcome to the Meet Your Fund Manager segment today, and we have a very special person for this particular segment where we'll be talking about the market conditions and your investment strategies. I have Rahul Singh from Tata Mutual Fund Equity CIO. Welcome to the show, the Money Show, where we talk about investment strategies which are the best, looking at the current market condition. But then before we go into or deep dive into investment specific strategies, I want you to help us understand the current market breadth, where the market is range-bound, looking at the global uncertainties. Even though we are strong at our own grounds, do you think the market is range-bound and not as upbeat as it should be? What could be the reason behind that?
Thank you. Thank you for inviting me to the show. I think the range-bound movement is a result of the tussle which is going on between high interest rates and, generally speaking, positive economic fundamentals. When I say generally speaking, obviously there are ups and downs, but in general in India, the economic sentiment or the economic growth outlook is much better than it is in the world.
Okay.
But having said that, the interest rate scenario is still not settled.
Exactly.
We don't know whether there are any more hikes left, especially in the US, and what impact it has on the valuation, because equity valuations are inversely correlated to interest rates. And even though we are getting earnings growth, we are getting economic growth in India, overall there is a pull down effect from interest rates on equity valuations.
Right.
So therefore this tussle is going to continue till we are at the end of the rate hike cycle, which could take another 6 months, 12 months, difficult to say. But the good part is that the economy itself is going in the right direction. It's moving away from just being a consumption-dependent economy to consumption plus investment-dependent economy, and now exports also. Because India is getting a lot of attention for setting up export-led manufacturing units as the world tries to move away from China. So all this is creating a good, I would say, 3 to 5 year outlook from the economy perspective. But we have to live through this 1 year when the world is still not very, very settled in terms of the risks, in terms of the interest rates. So I think it's a process. We as fund managers don't mind this period of 6 to 12 months because it gives us also time to assess the risks and also buy the kind of companies we want to buy the kind of sectors we want to buy. So we are quite confident that this is eventually a period which will result in better returns subsequently.
So do you think this is a very sector-specific market or a stock-specific market when we talk about valuations specifically?
It is a stock-specific market now. There is a little bit of sector momentum up and down, which keeps happening. So today banking is looking good, capital goods, manufacturing, infrastructure is looking good. But barring if you leave these couple of trends, it's pretty much a stock-specific market now, and it will become more and more of a stock-specific market, which is again something which helps good fund managers do better than the market. It's already happened in the last 15-18 months. I think the same will continue in the next 1 or 2 months. Having said that, there are always some sector calls you can keep taking. For example, urban consumption is not looking the strongest, but even within urban consumption, you will find companies which are doing much better than the rest of the companies. So, end of the day, you can follow the sector trends, but ultimately you are having to choose stocks which we think are going to manage this situation better than the other stocks in that sector.
In last 6 months, if I have to ask about your funds portfolio, were there any major changes that you've adopted or you've gone through or you've initiated just to beat the kind of volatility or the uncertain times that we are now into?
So we've added I mean, we've basically been positive on banks.
Okay.
We continue to follow that path.
Sure.
At every opportunity. Similarly, we were early in identifying infrastructure, capital goods, industrials as a space, manufacturing as a space where we have taken exposure across our funds. Some funds will have more than others, but generally speaking, that's been the trend. So these are the two things which we are obviously focusing on. We continue to be a little underweight on IT, which is something which we are still not clear as to when the sector will again start moving up. And in terms of the market capitalization, I think we are a little indifferent today whether it's a large cap, mid cap or small cap, because the way the economy is evolving, the investment, when the economy moves from just being a consumption to consumption plus investment, the market also broad basis.
Right.
And therefore you get more opportunities in mid and small cap to pick from. So we are today not very particular on whether we have to buy only large cap or mid cap, small cap.
Okay.
If we are seeing good opportunities, good companies, good managements in a good space, we are not really very worried about mid cap, small caps as a segment.
Okay.
In fact, even in the valuations, if you look at mid cap valuations are at a premium to large cap, but it nowhere near where it had reached in 2017, which was really a kind of a euphoric period. So we are in a period where we can be selectively looking at mid and small caps and not necessarily be very worried on that segment.
So the selective selection also includes having multi-baggers in your portfolio. What would be the criteria for selecting those multi-baggers, if I can call them that?
See, nobody knows multi-baggers till it actually happens.
Right.
So what we have to go for is there enough tailwinds for the company? If it's an average company, if it's not an average company, is the management good, is the balance sheet good, is the capital allocation good? And you back that. You back one of these two things. And that is how multi-baggers happen. It is not, at the beginning of the journey, nobody knows whether they are multi. Only at the end, you know that it was a multi-bagger. So we follow a very bottom-up GARP philosophy. So our philosophy at Tata Mutual Fund is growth at reasonable price.
Right.
So our starting point is valuation, but that's not the end point. The end point is growth.
Okay.
So how do we shortlist and identify companies which are reasonably valued, but which have a strong growth ahead of them? I think that's the essence of our philosophy, because if you pay a fair price for a certain asset or a certain company, the chances of you making above average returns go up.
Right.
Rather than when you overpay for that company, if it's a very expensively valued company.
Let's talk about crude and rupee. How is the movement? Is it really concerning you right now, the weakening rupee, and what levels in crude you think that will be comfortable now?
So we've seen $85, $90 and back. I think right now we are at a comfortable level. I think even if it goes up $5, $10 here, up and down, it's not going to change things dramatically. At the margin, it will always start questions on, okay, whether the interest rates will now pause or go up, etc. Those risks keep going up and down. But as far as equity markets are concerned and earnings are concerned, crude has become less of a role to play if it's in this narrow band.
Okay.
So we are not worried about it too much. At the same time, if it crosses 100, if there is another geopolitical issue, obviously it's negative for the entire Indian markets, not just on the profit growth, but on the valuations also.
Now, looking at the corporate earnings, which are expected to be muted, when you look at the forward-looking commentary, what are the points that you will be stressing on, or the points on your radar to make a strategy for your funds?
The strategy for our funds is very simple. So we follow growth at reasonable price as a strategy, which I think is something which is a strategy which works across the interest rate cycles, across the economic cycles. At some point of time when the interest rates were low, I think quality at any price, growth at any price, those kind of strategies started to do much better. But now we feel that valuation discipline has come back into the market. So that's point number one. Point number two is, like I said, the economy is moving from just being consumption to consumption plus investment. This is something which We have been waiting for last 10 years. That investment cycle revival is happening after 10 years. Whether you look at corporate investment cycle or household investment cycle, which is real estate basically. Both are reviving after a period of 10, 12 years. So we think there is some distance to go.
You think it's going to sustain? What are the factors that you are banking on?
Yeah, it is sustaining as of now.
Right.
We need to be watchful. One risk was that if interest rates had gone up too high,
Right.
then both the corporate capex cycle as well as the household investment cycle, which is real estate, would have not sustained that kind of growth.
Right.
But now that we are in a period where it looks like we should be near the end of the rate cycle, if not already at the end, that means that the interest rates will not keep on rising continuously on home loan rates and on the corporate loan rates, which gives the confidence that the capex cycle and the investments into real estate and sectors which had not done well will continue to sustain that growth. Because one of the big factors which is driving the growth in some sectors is also the fact that there is a lot of investment coming into India as an alternative to China over a 5 to 10 year period.
Yeah, okay.
For various reasons, mainly for geopolitical reasons. And that is a trend which can last for 5-10 years. Now within that, can everything go right? Everything need not go right. There will be things which will go wrong. But this is a huge kind of positive factor for Indian investment cycle, which we cannot ignore now.
Right.
We could have ignored it 1.5, 2 years back, but definitely not now. And therefore, interest rates could have spoiled it. Now it looks like stable, but can something else spoil it? There could also always be risks.
Exactly.
There will always be risks.
Yeah.
Political continuity is one risk. So we need to be watchful and be nimble if that happens. But so far, things seem to be falling in place.
Talking about China, you think them picking up their economic activities and raising their growth could be a spoiler for us, or you think that we've established ourselves really well when it comes to being replaced by China?
So I think economic growth in China was also export driven. A lot of it is export driven, and it's slowing down. Similarly, there also, I think the government is more focused on common prosperity and not
Right.
just unequal prosperity.
Okay.
And there is a certain amount of, I won't say negativism, but certain amount of neutrality towards necessarily showing very high growth. So their growth targets are 4.5% GDP growth rate for the next 10 years. So they're very clear on that. I think, yes, there could be short-term lifts like post-COVID when China unlocked, there was some capital flow which went there, but those are very, very transient.
Okay.
If you take a 5-year view, I think the trend is very clear that they are happier with slower growth today than they were, say 5 years back. And that's indirectly good news for India.
To our investors, time to rebalance your portfolio, or time to pump in as much money as you can, especially if you have a 10 years horizon or a 15 years horizon. How should one go about?
See, it depends on two objectives. One is how do you manage this period of heightened risk in the global markets. So then you keep the asset allocation healthy between debt and equity. And today debt is also earning decent returns. It's not the 5.5% return which we were earning 2 years back.
But you can still go heavy in spite of debt giving you good returns.
Yes.
On equity.
Yes, you can still. And also it depends on the personal situation. So depending upon what is your income level, how secure is your job, how well you're doing, how old are you, how many dependents you have, you need to be conscious of all those factors when you decide the debt and equity allocation. So there's no one single answer for a question like this.
Right.
And one of the products, for example, we have, which I always recommend, is the balanced advantage funds, because it takes advantage of the volatility in the equity market and also gives you some debt exposure all the time. So you are not missing out on that part if the yields go up. You're also not missing out on volatility in the equity markets. You can take advantage of the volatility, in fact. So that's one product which kind of navigates this situation quite well.
Personally, and last question to you, this is, personally, are you an aggressive investor or a conservative investor or somewhere in between?
We have to be, we have to play to the needs of that fund which we are managing. So for example, if I'm managing a small cap fund, I'll have to be slightly more aggressive than when I'm managing a balanced advantage fund. So again, I would not, there is an inherent personality which everyone has, but at the end of the day, you are managing certain kind of fund mandates.
Right, right.
And you have to navigate and tailor make yourself a little bit to align to the objectives of that fund.
Right.
I cannot be very aggressive in a balanced advantage fund in my equity allocation, and I cannot be very conservative in a small cap fund.
Yeah, yeah.
I can be quality conscious, I can have my parameters, but I cannot be very conservative. So that's how I would, that's where I would leave it.
All right, I think that will be all. Thank you so much for removing time for us today. Thank you.
Thank you.